welcome to the Man from Macro, where we look at some of the big themes in today's global markets. This week, the Japanese yen versus the dollar has been in the spotlight, touching 150, a level that Japan's Ministry of Finance defended last year. So why did they do it? And should they do it again? Well, it's a long story, but very briefly, it involves the 3 Ds. They are debt, which built up in response to the bursting of the 1980s financial bubble, demographics, which are in decline, and deflation, which as a result has become a major policy battleground. The battle against deflation is one of the primary reasons why Japan's economic policy has remained super loose. As a result, Japan's 10-year yields have risen at a much slower pace than the 10-year yields of the United States. And that has helped the dollar rise against the yen. But why do people care? Well, one reason is that the yen is used as a funding currency. Big moves in the yen can generate significant capital flows. But Japan's policy mix is always walking a tightrope. For instance, Japan's policymakers want good inflation, the type that equates to positive economic growth. And they have tried to boost economic growth by keeping yields artificially low. But capping bond yields requires the Bank of Japan to buy bonds, which in turn dilutes the currency, supporting dollar strength and yen weakness. The weaker currency might help increase demand for a country's exports, but it also boosts inflation by pushing up the cost of imports. Lower yields and a lower yen weren't really a problem until inflation showed up. And that's because inflation without growth can create a cost of living crisis for Japan's retirees. Therefore, if the decline in the currency becomes too rapid, then negative shocks can overwhelm the positive benefits. The Ministry of Finance may then need to step in to buy the yen and sell the dollar. And as a result, we can have the seemingly contradictory situation in which the Bank of Japan buys Japanese bonds to weaken the yen. Meanwhile, the Ministry of Finance sells United States treasuries to buy and strengthen the yen. But selling US treasuries could put upward pressure on US yields. And that helps strengthen the dollar versus the yen. Thus, the very action of supporting the yen could also undermine it. So, should policymakers step in? After all, the 150 level is just a number. Yes, there might be a bit of volatility if 150 is properly breached. But it's not the end of the world, and it might just help the Japanese equity market outperform. It may even regain the all-time highs that haven't been seen since the peak of the bubble in 1989. And one last thing, this doesn't constitute investment advice. Whilst my avatar presented this, it was still written by the real me. Thanks for watching.